In a lending landscape of increased competition and pricing pressure, first out, last out structures are showing themselves a timely tool for getting financing just right. Here with us today is Siemens Financial Services' Tom DeMauro to share more about FOLO's competitive advantages. Let's dive right in. Tom, can you give us a quick refresh on what FOLO is, as well as why it's an effective approach right now?
Sure. So at its core, FOLO is pretty simple. Two lenders, same first lien collateral in the same document, just different positions in the stack. So we typically sit in the first out, meaning we get paid back first, and we carry the lowest risk in the structure. Last out lenders sit behind us. They get paid out last, and they're taking incremental risk, and therefore they're paid more for that incremental risk. So that's the basic structure. That's the basic mechanic. Why it works right now? Honestly, the market's pretty the perfect setup for it. Banks have pulled back on leverage. Unitranche pricing has come down, sure, but that's actually part of the problem for private credit folks as they try to hit their targets. FOLO is a cleaner solution on both ends, really threads the needle. Sponsors get the leverage they need without paying private credit pricing on the whole stack, and private debt firms get to stay competitive with their pricing on deals they might otherwise be slipping out of their range. So right now, like I said, the market's really lined up perfectly for it.
All right, so it fits really well into current market conditions, as you said, but there are some pretty specific benefits to both lenders and borrowers, as I understand. Can you give us some detail about that?
Sure, let me hit both sides because they're pretty different stories. On the sponsor side, the big thing is leverage and access to flexible terms. With a FOLO, they get unitranche leverage that the banks just won't do. And because the first out piece is priced at bank levels, the blended cost is more efficient than going the full private credit route. But honestly, sponsors like even more the flexibility that these structures provide. So limited amortization, covenant flexibility. And one of the big things really is the ability to incorporate delay draw terms, accordion flexibility up front so that they can execute on bolt-on acquisitions that are core to their strategy. And they can do this without having to renegotiate the entire deal. We can bake it right into the structure. And if you're running a platform strategy, that's huge. For private debt, the story is really about what's happening in the market today. So unitranche spreads, as I mentioned before, are compressing quite a bit. And for a lot of private credit firms, those tighter spreads are starting to bump up against their return floors. They have commitments to their investors, and they can't just keep tightening spreads to win deals. So FOLO really solves that problem because the first out piece comes in at bank pricing. Last out lender can really hold their spread while staying competitive in the market. They stay in these deals that otherwise they really wouldn't be able to stay in if they didn't have a first out option.
Excellent. So kind of a win-win in theory, but in practice, tell us how you have seen FOLO deployed successfully.
Sure, we have a number of great examples. One that comes to mind is a FOLO that we did for a Southeast-based residential services business. We closed this a little over a year ago. The sponsor was running an active acquisition strategy, or they're planning to run that inside their investment thesis. They needed a structure that could accommodate this. We were approached by one of our debt partners. They structured a deal that could meet these flexibility expectations, but would otherwise be uncompetitive on pricing. So we partnered as the first out. Expected delay draws were sized according to the bolt-ons, and they were split between first out and last out. And over the past year, since we closed the deal, the funded portion of that facility has more than doubled as the sponsor completed 6 or so acquisitions. So our last out partner, they got their target return. The sponsor received competitive all-in pricing, and the structure was built for the business strategy or the acquisition strategy that the sponsor was employing. Everybody really won. And that's the point. The banks couldn't really get there on the leverage that was needed. Straight unitranche would have been more expensive, and frankly, our private credit partner would have had to stretch on their returns in order to get there. So FOLO was really the angle that worked for everybody. And it's a repeatable story. It's a better structure for the sponsor, better returns for private credit. It's better execution across the board. And once people see it, they tend to come back to the FOLO structure. That's what we found.
Well, you can't beat a win-win for all the parties involved. So Tom, thank you so much for joining us.
Thanks, Carolyn.